So, hello, here I am again, and the important thing is here you are again too, and that is very nice of you. So, let's talk today a bit about the basic aspects which you need to understand the problem of double taxation. So, we are now leaving the basics of taxation as such and go to a special problem, the most relevant problem of international taxation at all, and that is double taxation. Well, let's first repeat some of the basics because I know from my own student times you will probably have forgotten them. So remember, there was an unlimited tax liability, and that was a completely German technical term. Other countries would call it the taxation of residence, or the worldwide taxation, or the comprehensive income taxation. There are many, many technical terms in different countries for all the same thing, namely a tax liability which covers your whole worldwide income, ladies and gentlemen, and applies to natural persons who live in the inland, so have their residence here or their habitual abode, and it applies in case of juridical persons to juridical persons who have their registered office, that is their statutory seat, or their place of management in the inland. By the way, if you look a bit more closely to these conditions, you find out that if one behaves a bit clumsily, one can end up with unlimited tax liability in several countries because having a residence is possible in Germany. It might also be possible additionally in Austria or the Netherlands, and you might also habitually stay in a third country so that you would be covered by a kind of unlimited tax liability in three countries. Would be probably big fun for your tax advisors because you would have to declare your worldwide income in each of these countries, and that would be great fun for them because they could charge nice fees. The other alternative was a limited tax liability, and that applies only to income from the inland alone. It typically applies to all those people who are not yet covered by unlimited tax liability, so that is to foreigners. And what you always should keep in mind, at least in the German tax legislation and in the tax legislation of most other countries too, citizenship itself plays no role. Usually the criteria which trigger unlimited tax liability or whose absence triggers limited tax liability, these criteria are only related to where you live. We can understand that common sense says if it was my citizenship that triggers worldwide income taxation, I would directly renounce on my passport and become stateless. So the only thing which can be found is that perhaps your residence in a country or your habitual abode in a country or citizenship of that country triggers unlimited taxation. You will never have a country that renounces on the residence or the staying in the inland triggering unlimited tax liability. That would be rather implausible. Well, and so as citizenship normally plays no role, please keep in mind when tax advisors speak of German taxpayers or US taxpayers, they never mean the citizenship, they mean the people living there. So, under tax aspects, they would regard you as an inland taxpayer or as a German if you are unlimited tax liable in Germany if you stay here. And if they speak of foreigners, they would also include Germans living abroad. So the usage of the term inland person or foreigner does not include any allusion to citizenship, usually in the field of taxation. Just if you talk with a tax advisor or a tax expert, you should have that in the back of your mind. Good. And another important thing was income tax applies to natural persons, has a progressive rate, and there were 7 types of income in Germany. Other countries also usually cover the income by setting up a list, what is income and what is not. and there are very often some personal allowances for your personal situation if you are an unlimited taxpayer. Corporation tax, on the other hand, was applied for juridical persons mostly or only. There is usually not a progressive rate because that could be easily avoided by clever tax planning, so it makes no sense. So we usually have a flat rate, one single proportional rate in Germany at the moment, 15%. And the tax base is again all the income usually. Um, there might be differences from country to country. For example, if you live in England, a natural person would be taxed with current income under income tax and with gains from selling under capital gains tax, and the corporation tax would then include both types of income, the current and the capital gains. But in principle, corporation tax is the parallel to income tax or to income taxation for natural persons in Germany. So the 7 types of income are relevant too in principle, but the German legislator said some decades ago there were some legal forms which were only allowed to run if you were willing to run a business with them. That was the GmbH, the AG, later the SE, and cooperatives and so. And so tax law draw the conclusion that as in former times these specific legal forms were only allowed to run a business and not to do anything else, that anything which these forms of business then had as income must necessarily derive from business activities. Later, company law was liberalized. Now a GmbH can also be formed to run a chess club. But tax law was rather conservative. They said, okay, we once said everything which a GmbH earns is income from business, so it will remain income from business, because the advantage for us, the German fiscus, if something has income from business, then we can also charge it with trade tax, and that is what they wanted. So with most legal forms in Germany, which you know in the business area, the consequence will be corporation tax will also always lead to business income, and that also always triggers trade tax. Good. The German income tax tariff was highly complicated here. I have the tariff function of 2018. In one of the last lectures, I showed you the tariff function of 2021. You see, it's always a highly complicated formula. So that's the reason why the Germans usually use computer programs. Nobody ever understands how the tariff works. I told you something in one of the first parts of this lecture, what's the basic logic behind the brackets. In principle, it is a mass of very, very small brackets of less than a euro, where the rate progressively but very slowly increases from euro to euro, and some mathematician then formed a function which leads to exactly that result which one wants to have. Then progression stops somewhere at the moment at, I believe, 60,000. The bracket zones are also adjusted to inflation in the course of time, and the correcting factors for the for the areas of income which are not fully taxed with 42 or 45% also vary from time to time, but in principle you have such complicated things. Here are again the 7 types of income. The computation of the total taxable income would work as follows. You add up everything from the 7 types of income, but you leave usually out income from capital since 2009. That is separately taxed under a flat rate of 25%. In all cases where you do not opt out of that special regime. And then the total can still be modified by deducting special expenses. That is a special personal allowance for things like health insurance contributions, retirement savings, pension plans, and extraordinary expenses that could be also translated as personal allowances for extraordinary hardships. And then you arrive at the total taxable income. That was your tax base. Well, and one could also then think about cases to practice that. And here I have a small case. There you see what would be done in real life. For example, income from a job at Kleve, 60,000, income from a house in Munich, 20,000, income from selling that house, 80,000. The house had already belonged to the taxpayer for 15 years. Now, surprise, under no type of income that would be covered. Under German law, selling private property, so things which are not used for you to run a business, would be tax-free if you owned it at least 10 years already. So that's no income at all. License fees from a book which you had written, 1,000. Revenue from selling a car after 5 years, no revenue at all, because selling other private assets which are not real estate property are already tax-free after a period of 1 year. Income from a house abroad, now you know worldwide income principle. And if that house is rental income, so current income, it would be covered by lease and rent income, so it's 50,000 taxable income. Income from a factory belonging to you in a country, in the foreign country of chaos again. Chaos is a fictitious country. I like it. It's a confederation of highly autonomous, obsolete statelets. And there you earn 80,000, and then you get a dividend from 20,000 and an interest from a bank account and have some special expenses. And in the end, you would just deal with such a case in a way that you check every individual event if it's covered by one of the 7 types of income. Then you add everything up, and then you would be deducting still the personal expenses and extraordinary expenses. Here they are given, and then you would apply the tariff function, and then you know what you would have to pay. Well, now let's go back, or let's proceed to the really interesting stuff. That is, if somebody has a cross-border situation. Imagine Mr. Smith now lives in Germany and has income from a house in Is Not So Bad. That's the capital city of Faroestan. So there he earns 100 euro, and Faroestan naturally will have a limited tax liability where Mr. Smith will have to pay Faroestani tax. Now in Germany, also income tax is levied, and it covers the worldwide income, and Is Not So Bad is in the world, so the 100 euro are covered by the German tax claim too. So you will end up with 2 taxes on the same income. Which economic consequences does that entail? Well, imagine now Germany has, and now I'm a bit more brutal than life can be at the moment, I just assume Germany takes 60% and Faroestan takes 50%. So Faroestan taxes the 100 and claims 50 income tax. Germany also says you earned 100 and claims 60%. So after you paid both of the taxes, you end up with minus 10, because the total of both taxes would be 110. You make a loss. You can't compensate for that loss by being more busy and being more productive, because if you earn 200, the result would be 220. So no chance. And in real life, if you manage to pay the both taxes here, at least in one of the 2 countries, the tax office would begin investigations. From where did you have the missing 10 euro? You can't have earned them there, so they must come from another source. And why didn't you declare that? So they would try to find out if you committed some tax fraud and forgot some other income, or if you had some property from which you paid it and which they do not yet know. So that would be catastrophe to the power of 2. So What can we do against this? We must do something against this, because if the previous situation would stand uncorrected, nobody would ever do a cross-border investment anymore. Yeah. The first idea would be, okay, let's prove to one of the two states that they have to renounce on their tax claims. And the answer is international law gives you no claim to demand that. Every state will even say, we do not discriminate against you. We charge you with exactly the tax which our own taxpayers also pay. So we do you no injustice. Um, they both will say it's the fault of the other state. They should show some compassion. Or it's the fault of the world. The world is not perfect. Now you go bankrupt because of profits just by the clash of two tax laws. Well, not nice, but life's hard. Don't worry too much. You could also have fallen down the Eiffel Tower and died. You could have died in an air crash. You could have run over by a bus, and now you are killed by taxation. Take it with a smile and don't whine around. So, people are this way. So, the clash of two different legal systems might have catastrophic consequences for the people who are in the middle between the two law systems and then are crushed. And nobody feels responsible for that. You have no legal means against that, apart for cases where the states agree that something should be done. They must do this either unilaterally or by an international agreement, but you need them to become active. Otherwise, you have no chance. And that is what we will observe later. The states in the area of taxation, where these problems are everyday problems, where they touch every cross-border situation where money is in play, and where it can easily be explained what happens and is not a rare case. There you can motivate states to react. In other cases where, let's say, family law discrepancies create a catastrophe for a married couple moving to another state, that is then usually a rare case which nobody ever takes up, and where it takes decades before state parliaments worry about the situation, because they are not going to change their legal systems for a single case. That would be rather your personal problem. So in the field of taxation, we have, and that is important, one of the very, very few areas where you probably get a quick reaction of the legislating bodies of both involved countries, because that's business and everybody wants to do business. So we would see as a first consequence that the tax rates with 50 and 60% coming together would be intolerable. But nowadays, lower tax rates are realistic. So imagine it's only 30 and 30%. Would a cross-border contract work now? And the answer is, let's calculate. We would have a German tax of 30, a faraway Estonian tax claim of 30, and 40 would end up. Now you could do investment in Faroestan, but it will not happen, because if you invest alternatively at home, you would have a net result of 70. And if you have the choice between having 40 euro net result or 70 euro net result, you would probably have to be a madman to decide for the 40 euro alternative. So cross-border contacts are even improbable or highly implausible, economically nearly impossible if you have a double taxation. Even if it does not surpass the 100% threshold, this extra burden which you have to bear in the cross-border relation deters you immensely from cross-border activities. The consequences would be everybody stays at home. You invest only in your own country. There will be no cooperation with a foreign country. No patent rights will be granted to you to a foreign country and vice versa because, well, it doesn't pay off. Oh, well, that's not enough which remains after tax. You would not, yeah, not or nearly never buy shares in a foreign company. No big enterprises could be set up because for big enterprises you usually need to collect money from several states. You could not have um, cross-border cooperation in a way that you have a cross-border supply chain organized by a multinational enterprise. All these things which nowadays, due to economies of scale, keep the cost of production and therefore the cost of living low, would not be possible. So let's conclude first what double taxation does if you don't do something against it. Double taxation leads normally to a complete breakdown of any business activity in the cross-border area if the rates go higher than 100% if you add them up. But you have similar effects if you have lower rates, because then the additional second tax which you have to pay in the foreign country deters you enormously from doing cross-border activity. So international world stops if you have double taxation. And ladies and gentlemen, you must imagine or make yourself clear one thing. What I'm talking about now is not abstract theory. That's hard and harsh reality. Huh? Business is about money. And if you have an impact on rentability, the markets react. So what I lay you out here is going to happen if you don't do something against double taxation. And that is why states usually have the insight double taxation is extremely dangerous for economic prosperity of our countries, at least in the long run. In the short run, when you are the owner of a gold mine somewhere in Africa, I always bring that example. I don't know why I have the idea that all the gold mines must be in Africa, but sorry, one has some innocent prejudices. And by the way, naturally, we all dream of having a gold mine in Africa and an oil source somewhere in Kuwait. And so, yeah. So please don't feel misjudged if you are from an African country where there is either no gold mine or where you think there is more cultural advance than only a gold mine. Everybody knows it. So what we want to do in the final effect is we want to avoid dangerous effects for our economic wealth, and so we need to remove that additional tax burden from taxing people twice. Now, to be exact, it's good to think about what we see as double taxation. Double taxation is not everything, every case where somebody is taxed twice. For example, within Germany, you are taxed with your business income, with trade tax and corporation tax. That's taxing the same income twice, but it would not be regarded as double taxation in the sense that we talk about, because in Germany, within Germany, the double taxation or taxing you twice with business trade tax and with income tax or corporation tax, that's normal. Everybody is used to that. It doesn't um, influence competition. Huh? If you want to make a profit, you know you will have to pay these two taxes. So, or you will have to pay income taxes. So that's normal. But in a cross-border situation, when you have to pay German income tax and the foreign income tax on top, then this taxing you twice creates an extra burden, which is not there in the comparable inland situation. And that has a distorting effect on investments. And that is what people want to avoid and what needs to be avoided. So normal taxation, which happens twice, is okay. Only if the cross-border taxation which happens twice, creates an extra burden, then it must be fought, and that is what people understand in the field of international taxation by the term double taxation. So we mean double taxation is taxing the same person with the same kind of tax. Naturally, income tax has another name, a different name in the other country, but it's the identical tax when it comes to looking on what really happens. On the same part of income, naturally, if you have only to pay once tax on your salary in the Netherlands and once tax on your interest income in Germany, that's not a double taxation. You can live with that. Everything is taxed once. But if you have to pay two taxes on your profit from far away, first there and then at home, that is an extra burden which makes the cross-border investment brutally unattractive. And naturally for the same period of time and by different states. So taxing the same profit in the hands of the same person with income tax and trade tax is not a double taxation because it's done by the same same state, and therefore absolutely normal. Good. Here I just want to remind you that naturally if you behave in less intelligent way, you can even multiply double taxation and turn it into threefold or fourfold or fivefold taxation. For example, have two houses, have a factory in state C, and the factory then gets an interest payment from state D. Then two states, C and D, can think that they are the source of your income, so you could be subjected to limited tax liability in C and D, and state A and B could feel entitled to tax your worldwide income. In that cases, congratulations, you will easily end up with more than 100% if there is no measure taken by the states involved which protect you against this effect. And usually states want to protect you against this effect. Good. Now, what can be done against double taxation in principle? The first idea would be eliminate one of the two taxes worldwide, like we have in the field of value-added tax, where everybody agrees. That's a silent agreement, unwritten, but absolutely binding for all the states, that indirect taxes are always only levied in the country of destination of the good or service. One could try to establish such a principle worldwide too, just that kill one of the two kinds of taxes. I am going to explain you soon why that is not possible. But here I think we have just talked a bit and need a small break again, so we are going to start with that topic in the next small video. Thank you for watching and enjoy the break, but come back. I am looking forward happily to see you again for the next video, and that will be soon. Thanks.